Hi, I'm Malcolm Graham Wood, and today I'm doing another Core Finance CEO interview. I'm delighted to say that my guest today is Andrew Hockey, CEO of IOG. Welcome back, Andrew.
Thank you, Malky. Good morning to you, and thanks very much for inviting me. Pleasure.
It's great to see you again. I'm sure, nowadays everyone knows all about IOG, but I always say just a couple of sentences as an overview would be great for people who are looking at it for the first time.
IOG is listed on the AIM, on the London Stock Exchange. Our focus is the UK Southern North Sea, and specifically the UK Southern North Sea gas basin. So we're focused on gas. We want to grow up to be a substantial developer and producer of gas in the basin. It's an area that we understand very well geographically. A number of things, perhaps for people who aren't familiar with us, who I'm very keen to talk to directly today. We are in the midst of our core project at the moment, going through our phase 1 development. We're funded for first gas, which we expect to deliver from our development in the third quarter of next year. We have a very clear strategy, very disciplined strategy. We're focused on returns for investors, and because of the way we're set up, because of the way our business model works, we can deliver high value incremental gas to the fundamental infrastructure that we're currently putting in place. So it's a very exciting proposition. Another key point is, unlike many of our peers, we do actually own our own infrastructure. We own our route to market, and that's quite a unique position to be in for a company of this size. So that's important to say as well. Over the last year or so, and I'll develop this theme a little bit later on, but over the last year or so, we've built up a team capable of delivering our project, and on beyond that, building the company on beyond that. And that's all off the back of a very substantial reserve and resource base that we've built up in the gas basin in the UK over the last few years. So a very exciting proposition coming up, looking at first gas third quarter 21.
Excellent. That's a decent, fulsome introduction. Thank you for that. Those of us who've watched it all the way, it's been quite a long journey getting you to where you are now. But you are now, as you mentioned, on the cusp of delivering a very material Southern North Sea development. You've mentioned a couple of times that you put a great team together, and having been to your offices and so on, I can tell that you've got a substantial operating team, which is what's necessary, which is in place to deliver that phase 1 and beyond. So talk about the way you've adapted to the challenges and how you've got on this year, a key year in delivering the core project.
Absolutely, Malky. So whilst last year for us was absolutely about getting ourselves funded, getting ourselves in a good position financially and ready to push the button on the project, this has been much more about delivery this year. And so on the 28th of October last year, just a little over a year ago, we took final investment decision on phase 1 of our project with our partner, Cal Energy, and we were able to kick off the project. I was very pleased to be able to do that at the time. The important thing, and the thing I think I've learned over the years, is you've got to be properly resourced to do a project like this. So as you say, one of the biggest things we've needed to deal with is actually getting the right team in place and designing it, getting it ready for delivery. So there's been a great effort across all disciplines, all the way across subsurface, drilling, engineering, finance, HR, to build an organization that really can deliver in the past year. And I think we're up to almost 50 people now in total, which is absolutely right size for delivering our phase 1 project. So here we are, team in place, and very much in the thick of it now, getting on with phase 1 of the core project.
Excellent. To the uninitiated, as someone said to me, it seems like a very complicated project which has taken a long time, but actually, given the different elements that you've got to put into the process. But you said a number of times that it's a simple, low-cost, low-tech even project, and I'd be interested to hear why you say that, because obviously you've got a drilling program which is 5, possibly 7 wells. You've got a pipeline, you've got infrastructure offshore with 2 platforms and more. You've got onshore at Bacton and everything else. That seems like an awful lot. Why don't you tell us how you're putting it all together?
Okay, well, you've made it sound very complex now for me, but I will actually attempt to to break that down into bits and actually explain why I think it's simple. I mean, firstly, here we are in the southern gas basin of the UK North Sea, dealing with a basin that's pretty well understood from a subsurface point of view. There's been gas produced from here now since 1967, when West Sole field came on stream, so back in the mid-60s, and natural gas came into the UK. So we understand the fundamentals here in terms of the geology, the play system, what it is that we're dealing with. And then I think what we've really then tried to do is break it down into simple components so that we can string them together and deliver value from the project. And the way I would describe that currently is what the team are focusing on 4 key work streams, really. So going from onshore to off, the key part of any gas project is getting your product into market. And ours is going to come into market on the Norfolk coast in England at the Bacton gas terminal. And there we've purchased what's called the Thames reception facility, which had previously been decommissioned. And our current activity there is actually refurbishing that. So that's quite a simple piece. Take something that's been used already, refurbish it, reuse it. That's a very low carbon approach to the entry point into market. So that work is already ongoing. So that's piece number 1. Piece number 2 is what we call pipeline and surf. That means subsea umbilicals, risers and flow lines for the uninitiated. So part number 2 is the big component of that is the Thames pipeline, which again is a 24-inch line that we acquired a few years back and are now busy recommissioning, and then adding on the necessary spurs to our portfolio to that pipeline so that we can hook everything up and bring our gas into market through Bacton. So that's piece number 2. Again, activity there ongoing right now. We have 3 vessels in the field offshore Norfolk right at the moment, out there laying the 6-inch and 12-inch lines that we're going to need to tie in the Blythe and Elgood fields into PL370, our 24-inch trunk line that comes into Bacton. So that's ongoing as well. So another very simple piece. So one piece is to bring your gas into market. Second piece, bring your gas from the field into the coast. Third piece, of course, is you need to have a facility offshore to gather the gas together, to get it into the pipeline and bring it in. So to basically corral the gas that's coming in from your wells. And that piece is the production platforms and subsea infrastructure that we're going to be putting out and tying into the lines that we're currently laying. So that third piece is made up currently of 2 platforms being built in the yard at HSM over in Schiedam in the Netherlands. That's the Blythe platform and the Southwark platform. So that work is ongoing now and is looking to be ready to finish off probably in the second quarter of next year for installation. We're looking at early in the second quarter. So that's now we've effectively got everything above ground and above seabed, if you like, that we need. And then we come on to the 4th piece, which of course is, for me as a geologist, is always the most exciting piece, which is drilling the wells. And in phase 1, we're going to drill 5 production wells. You will have seen this week that we've contracted the Noble Hands dual jackup to do that. So we were very pleased to do that. And we're looking at a really meaty drilling campaign here. 15 months or so of drilling to get those 5 wells done. There will be 3 over at Southwark and 1 at Blythe and 1 at the subsea tieback at Elgood. So those are the 4 key elements of the project, really, in terms of the engineering and subsurface work, Malky, and all ongoing currently.
You've explained that extremely well, if I may say so, Andrew. Thank you for that. Well, while we're on that we're talking on the first day of the second lockdown period. So for quite a lot of this year, first of all, there's been lockdown, which must have implications for you and your staff and your contractors and so on. And secondly, it were locked down because of COVID. So I'd like to know, how has the virus affected your work?
I think it would be sort of heroic to pretend it hadn't affected our work. It has affected our work, but like as with anything, any sort of adversity, it's really how you turn around and try to manage it. So I think our team has really coped very well with the situation, and we continue to work hard at it to cope with the COVID situation. And we, right at the beginning, back in March, set out a very simple threefold strategy, if you like, for dealing with it. First and foremost, we want to look after our people, our staff and our contractors. Secondly, we want to make sure through the pandemic that we deliver our project. And thirdly, we want to keep ourselves as a company in a position to be able to continue on as a strong business and build into the future. So we've taken a number of steps to make sure that our staff and contractors are safe. We obviously locked down with everyone else through March, moved to remote working for the office. We brought a little bit of CAPE functionality back into the office through the summer in terms of a shift system. And there is a necessity to have a small presence here from an emergency response and crisis management point of view. So we've kept that as well. But the main thing, I think, is that in what aren't really normal working times, we've looked all the time at what the risks are around COVID, what they could do to the project, and then aim to manage and mitigate them as much as possible. And we're going to keep on giving our all doing that, but it's really the only way you can do it. It throws things at you, and all you can do is manage the risks that it throws at you and mitigate them as much as possible so that it has as least effect as possible. I think any operator currently will tell you, any offshore operator will tell you, it is a big challenge, COVID. If you're putting people offshore, we've got boats offshore at the moment with Subsea 7. We will have a rig next year. So you've got to manage very closely the risks that it throws up around you. And I think we're still successfully doing that and have done through the course of the year.
Thank you for that. For as long as I've known this, it's always been called the core project phase 1, core project phase 2. But I do know that there's more in your portfolio than just this. What else is there? I mean, I know that you're obviously predominantly only considering this at the moment, but you've got more in the box, haven't you?
Yes, absolutely, Malky. Yeah, the map behind me on the wall, which I won't point at because it would be too small for the camera, but it describes it very nicely. I mean, phase 1, I've talked about already. We're actually putting the infrastructure in to develop, and that is Blythe, Elgood, and Southwark. But phase 2, perhaps, is now having an increasing profile. We've taken on a dedicated manager to run phase 2 for us, and that is Nailsworth, Elland, and Goddard. And we're doing a lot of work on phase 2 at the moment. We're particularly refreshing our subsurface view of the phase 2 assets. We have, I think this year, we've reprocessed 1,200 square kilometers of 3D seismic data to get a much better subsurface image to give us the very best understanding of the subsurface that we can. Put that in context, I think Greater London is about 1,600 square kilometers, so that's about 3/4 the size of the Greater London area that we've reprocessed our 3D over. And then in addition to the phase 2 assets, we also have other upside in the portfolio. First and foremost, down at Abbeydale, which is a block that we picked up in the 30th round a couple of years back now. We're very much working that up as well. The area around Goddard, of course, and the area to the east of Blythe as well, in that part of the portfolio. So lots of opportunity already existing in the portfolio. And then, of course, we've made some recent additions, which we can come on to in the 32nd round.
Yeah. Well, yeah, that was my next question. So you were awarded 4 new blocks in the 32nd round. How do they fit in with your plans? Are they sort of identical? Are they going with the existing core, or is it sort of more step out? Or talk us through it.
I think step out's the key word in there, Malky. You've got that absolutely right. And then one area east of Blythe, and then the other area east of the Vulcan satellites. And I think the common thread through here always is returns. So we want to look at, we pick these assets up through the round, and we want to look at assets that can deliver us high returns when we develop them incrementally into our own infrastructure. So first and foremost, that's what we looked at. Secondly, obviously, we look for discovered gas. So perhaps assets that have been unloved in the past for a variety of reasons, quite often through no fault of their own, or the commercial route out hasn't been there. So discovered gas that we can bring in through our own portfolio, that helps ratchet up the returns as well when you develop the gas that way. And so returns, volumes, and ability to bring it in through our own infrastructure. So we're sticking to the script in terms of our strategy there, and in terms of what we apply for in the round. And I think that's why we tend to be quite successful in licensing rounds, because our approach is very much, we look at it through the lens of, we have infrastructure and we can bring gas in through the infrastructure, and that helps us be quite competitive.
Excellent. On a sort of similar but slightly extended note, and this is a question I have to ask, really. I'd be killed if I didn't. I am interested in your strategy for non-organic growth, and I say that because you recently disclosed that you'd made 2 unsuccessful approaches to Deltic Energy. So the obvious question, which the viewers would want me to ask, is what is your acquisition policy?
I think I will give an unashamed plug here to our new investor presentation that we put out earlier in the week, and then on particular on page 19 we describe our overall approach to our portfolio in some detail. But I think I'll take that specifically because it's the outermost ring of our strategic plan for our portfolio, Malky, on the diagram in the presentation. Basically, we are open to looking at acquisitions that add on to the portfolio at the right price, and if they deliver the right returns. I won't say too much about Deltic, but clearly we felt there was some industrial logic there. Down the line, it would have added some relatively low risk exploration into the portfolio in a part of the basin that is becoming increasingly well understood. And we felt that there was an industrial logic there for doing that, but we at no point were going to pay more than we felt was the going rate for the assets. And so after a couple of approaches, obviously we decided to pull back from that. But we are, I just stress again, we are open to acquisitions at the right price, and if they are if the assets are the right kind of assets to fit with our portfolio.
Excellent, thank you for that. Looking at the bigger picture for a minute, you've always concentrated on gas. You've talked all today about gas and its importance in the energy transition, as it's called. I've got a couple of questions on that. First of all, will you always only be a gas play? And secondly, how do you manage the economics? And I say that because last year the gas price had big movements. This year has been no exception. We had a big fall in the spring, and then this year now we're seeing the gas prices being fairly high. So the second part of the question is, I'd like your view on gas prices going forward. It's an impossible question, but I have to ask it. So only a gas company, and what about the gas price?
Yeah, I'm glad you didn't ask me the oil price, my oil price view, because that's even more difficult. I think, I can be very, very clear on this strategically. We are going to stick with gas. That's our plan. Sticking with that strategy is working well for us at the moment. I think, answering the first part of your question, so there's no plans to move away from that strategy. Gas we do regard as the low carbon option, as a transition fuel as we move towards a more renewable future, clearly, and obviously it has the lowest carbon intensity of all the fossil fuels. So what we've seen over the course of the last year, frankly, was pretty scary through the summer. I agree. The gas price here in the UK has gone up 4 times now between June and September, and now we are up at national balancing point prices of around 40 pence a therm. And that's great. Our business works really well at 40 pence a therm, and above that, it works even better. So we're pleased to see the market normalizing somewhat in that respect, and nicely in time for us, hopefully, to come on stream. And also, of course, we will look at gas price volatility risk as we get closer to first gas next year. We do have a hedging strategy. We will have hedging in place by the time we come on stream. So we'll be protecting our downside in that respect. In terms of how do I see it globally, I do think that this year was a bit of a perfect storm. Earlier in the year, we had COVID, we had a warm winter, we had an LNG glut, we had a number of things piling up that caused us the drop as low as, I think, 10 pence a therm at one point back in June, July. But we do see, as I say, I see the market stabilizing and normalizing, and the forward curve certainly around the 40 pence level going out suits our business, and it does very well at those prices. So I think a number of things are coming back in balance, and we see it as a good opportunity to get the development done in a period of relatively low prices, and hopefully then produce through a much more stable period where prices have improved greatly.
Yeah, and that sounds absolutely perfect. So thank you for that. I have to ask everybody this as well. What about ESG? What is IOG's approach to the ESG situation, Andrew?
Well, again, I'll plug the investor presentation where there are some numbers in there on that, but we do see ourselves as having a differentiator here. It is a differentiator for us, ESG, because we're first and foremost because we're focused on gas, the lowest carbon intensity fossil fuel, and also because the way we've designed our project, it's designed to be relatively low tech and certainly low carbon. The reuse of the terminal at back, again, working from onshore to off, the refurbishment of the terminal at Backton, that doesn't require lots of new build to be done. The refurbishment of the pipeline, again, don't require a major engineering project to put an export route in for our gas. That helps. We've designed very simple unmanned installations that the gas will be received from the wells into offshore, and then and they're designed to be run effectively remotely from the onshore. So our staff will cycle or drive to work. So we haven't got to fly lots of people offshore in helicopters all the time. That reduces the carbon footprint, and we'll be looking at all the time. We'll be looking at keeping our operating costs and our carbon footprint down by running the project in that way. So designing it in a low carbon way from the beginning allows you to get that win in terms of the carbon intensity that we have overall. So very important for us in the context of net zero in terms of the energy transition to stick with gas, I think, and we will be sticking with gas, and we do see it as a differentiator because of its ESG footprint.
Lovely, thank you for that. The other thing I'm always accused about doing is going on about finances, but I think it's important, whoever I'm talking to, over the years you've used debt, you've used equity to raise the money for the project. Can you give us a quick run through the balance sheet, how it looks, and what your plans are to fund IOG in the future?
So obviously, let's just go through the funding that we currently have in place. Last year was a pretty tumultuous year for us in getting it all sorted out, but we did end the year having done that and at a position where we raised £40 million up front from our farm-in from Cal Energy to get the project kicked off, and then two big development carries of 60 and 65 million pounds respectively to get us through phase 1 and phase 2. So effectively to pay our way, IOG's way through those parts of the project. And then alongside that, obviously, the €100 million bond that we raised that process closed out in September 2019 to give us the final piece of the jigsaw and make sure that we're funded to first gas here as we are now, and indeed beyond phase 2. But obviously where we really want to get to is hopefully where we're going now, which is we're going to be producing gas next year, and we're targeting Q3 2021, as I've said, and then that will give us cash flow, and then that cash flow can be both reinvested in the project, and then in the long run we can look at how we deliver returns back to our shareholders. So I think that those are the kind of stages that we're going through: funding phase 1, getting phase 1 to cash, and then being able to deliver the rest of the project, phase 2 and other work, and having free cash point forward from there. So that's how I see the finances evolving now, an increasing emphasis on having the free cash from the latter part of next year.
Lovely, thank you for that. As we get towards the close, I've got a couple of more sort of ethereal questions, but first one is that you must have some sympathy for me because I'm preparing my new bucket list at the moment as we come into November, which is a sort of restarted project, and at something over $40 Brent, I'm seeing quite a lot of oil companies that look very attractive, particularly cheap in the long term, intrinsically very attractive, and you are one of them. So the question is, how do we split you from the rest of the pack? What makes IOG super investable?
Hopefully, I'll tease out some of the points perhaps to answer that that I've made earlier on. I think really what are our USPs? Well, I think it's pretty easy to say. We've got the team in place to deliver now. That's really important. I've learned that over my career. You don't get anywhere unless you resource the project that you're doing. We take a very disciplined approach in terms of capital investment and in terms of the opportunities that we look at. We're not interested in them unless they deliver really solid high IRRs. We're focused on that, not focused on volume or anything else. We're focused on delivering for investors. We want to bring in incremental production eventually into our base infrastructure that delivers those high returns by doing it incrementally. So we want to get good effectively at doing projects and being a project factory, so we can easily add on high return increments into the base plan, the base infrastructure. We're working in a basin that we know and understand. There are still lots of opportunities there from licensing rounds, from undeveloped gas, from gas that got left behind, and as we've seen, from potential acquisitions. So I think as all that happens, we look at all that very disciplined approach. Also, with the core project, we've also got an opportunity to see this happen over the next year or so. As we get closer to cash flow, I think the market will start to value us more accurately. Yeah. At the moment, I feel we're obviously very highly undervalued in terms of our share price with respect to our intrinsic value. But I think as we move closer to cash, that will unwind. We'll get a much better performance, and that's hopefully starting to happen. I think one more point I'd make, obviously the sector is out of favor. The sector that we're in, small E&P, small oil and gas companies, have been somewhat out of favor with the sector. We, however, we do have a number of things going for us. We have lots of catalysts along the way as we move to first gas, as we deliver the project, as we move next year. We have a very favorable ESG profile in terms of a low carbon profile. The gas market we do see improving, so our commodity background is improving for us as well. So I guess with all that, through all the gloom of the last few months, we're a bit of a misery buster, really. That's how I see us. We can knock away some of the doom and gloom and be a bit of a misery buster. So I do see us well set now to move towards first gas and for our valuation to improve. So a lot to look at there. We've demonstrated that we are interested in growing the company and adding to the portfolio. So a very positive 2021 that I'm looking forward to. And I would say again, the investor presentation that we put out earlier in the week is fairly comprehensive. So if people are looking to get a good view of us and what's going on, I point you to that as a good summary document to take a look at.
Well, that's great, and that pretty much answers the final question, which is always where do you see the company in 12 to 18 months? Now, interestingly, that in the 10 to 12 months period, you'll be, say, 12 months from now, you should be first gas. So you don't really have to add much, but if you do, just a couple of lines for a final.
Well, I think obviously we'll be keeping our eyes open as to potential additions, but I think equally important, and I mentioned it earlier on, is that we do have dedicated force now to look at phase 2 and other pre-development assets, and we'll be, hopefully by this time next year, we'll be having a clear view of where we're going to slot some of those assets now into phase 2, and we're being able to take FID for some of the phase 2 assets so that we can move on and start adding really high incremental gas into our phase 1 infrastructure that we're currently putting in place. So there's lots to look forward to.
Brilliant. Thank you very much. And Andrew, thank you very much for joining me again. It's been great to see you today on Core Finance. My name is Malcolm Graham Wood. It's been a joy to welcome Andrew Hockey, the CEO of IOG, in today's CEO interview. Thank you very much for watching, and I look forward to seeing you again soon. Bye now.